So at what age would you start looking at that wealth transfer piece? So if you're accruing wealth and you're in your 40s and you've got kids, or would you leave it to your 50s? When would you start the process of almost like forward thinking, forward planning?
Well, I think most people have got to they've got a responsibility to themselves to make sure that they've got enough money to look after them into their retirement, and that they've got enough money to see through contingencies or market crashes or whatever. So that should be people's first concern. And the second concern should be, can we then leave this money in a manner that's useful and also tax efficient?
Okay. Yeah. So inheritance tax is one of those subjects that does get a lot of press coverage from time to time, and it seems to be something that a lot of people seem to know something about, particularly like your mate down the pub that wants to kind of say, here's what it is, here's what you need to do, here's how you avoid it. So this is a space that you work in a lot.
Yeah.
So start by giving us an overview of it. What are the thresholds? How does it start?
Okay. So yeah, as you say, everyone and their dog's got an opinion on it. And for a lot of people in the UK, at the moment, they won't have to pay inheritance tax.
Yeah.
So, everybody gets an exemption of £325,000. So if your total estate's less than £325,000, you haven't got anything to worry about. If you're leaving an estate which includes property or money derived from property, there are a few small caveats, but we won't go into that, to a direct descendant, which can include stepchildren, adopted children, then you are also entitled to what's called the residence nil rate band. Now, the residence nil rate band is a very complicated piece of, unnecessarily, in my opinion, piece of legislation, and it sometimes can be disallowed, and the different bits and pieces, but essentially it's another £175,000. So if you are a married couple, it's very easy to accrue reliefs of £1 million that might fall on the second death.
Yeah.
So if you're a married couple and you've got less than £1 million worth of assets, the chances are you won't trouble the inheritance tax scorers, provided you're leaving all of your estate to your children, and or grandchildren, but direct descendants. So not your brother, not your sister, not your mum and dad, but going down the line.
Not your mate down the pub.
Not your mate down the pub who's giving you the advice.
Fair enough.
So that's important to understand. The next thing to understand is that, as I said, it's a bit of a complicated piece of legislation, but essentially at a £2 million estate, you start losing that residence nil rate band at the rate of £1 for every £2 above £2 million. So in simple terms, if you get to £2.7 million, you've lost all of your residence nil rate band on both lives.
Yeah.
So it can be useful, and one of the things that we talk to our clients about a lot is segmenting an estate for a married couple, where on the first death, you utilise those two nil rate bands and immediately secure £500,000 out, which takes it away from the totting up aspect.
Okay.
And make sure that, they might, for example, they might take it away in a future budget and you're waiting to use it.
Yeah.
Yeah. So if you use it on your death, it might very well be a better option.
Fair enough. So let's just say that you go way north of that figure.
Yeah.
And you've got what some people call like an inheritance tax problem, where you've got a bill on the horizon.
Mm-hmm.
Quick kind of summary. What are all the different ways that you could deploy?
Okay.
So these aren't recommendations, but these are just an overview.
No, they're definitely not recommendations. Because everybody's circumstances are different, right? So there's four simple ways. Yeah, in simple terms, there's four ways. The first way is to spend all your money, right? If you can burn through every bit of cash you've got and get yourself under that £1 million or the £500,000 if you're a single person, or 325 if you're not leaving it to children, if you can get down to that number, you haven't got a problem.
Mm.
The challenge with that comes because most people who are already troubling the scorers are the sort of people who have invested well, they've saved, they've been diligent, they've denied themselves things to make sure that they're safe for the future. It's very difficult to go from being somebody who has that mentality to somebody who says, oh, actually, I'm going to turn left on the plane rather than turning right.
Yeah.
You know? And we tell all our clients to enjoy their money, not in a frivolous or irresponsible way, but you've worked hard for it. So make sure you enjoy it in your lifetime.
Yeah.
And perhaps early into your retirement or whatever, because by the time you're 80, you probably haven't got the energy to be flying long haul to the Seychelles twice a year.
I was just going to jump in and say, I guess that's where equity release comes in as well, doesn't it? And this is why people who are asset rich, kind of cash poor. Is this one of the arguments that some people then use equity release to release cash from property they got to spend, whether it's a motorbike, whether it's travel, whether it's uni fees for the kids?
They can do. I mean, equity release for a long time was two dirty words.
Yeah.
But those products have become a lot more sensible. They're still expensive, and they're still perhaps, not quite a last resort, but something that you wouldn't deploy on day one. But they can still be useful. So, and if you were going to do that and spend your money, then that's great. I wouldn't necessarily be suggesting to anybody to equity release and then just put the money in the bank.
Yeah.
The second way that you can avoid inheritance tax, coming through my 4, and I'll whittle through, work out what your bill is, buy a life insurance policy, write that under trust, and it's important to write it under trust so it doesn't also fall into the estate, because that would be, that would be in the realms of making an expensive mistake.
Yeah.
Write it under trust, and to some degree, you've sort of done your bit during lifetime. Yeah. People sometimes shy away from that because they think, well, hang on a minute, it's going to cost me another £5,000 a year so that my kids don't have to, or my grandchildren don't have to pay a bill.
Yeah.
People are very rarely on the wrong side of that equation.
Mm-hmm.
For a 60-year-old person, you probably have to live to be the best part of 100 to have not made money out of that.
Yes.
Yeah.
So what you're describing there is the cumulative build up of all the policy payments that you've made, offset against the money that you're leaving behind.
Exactly. Yeah. And also, because you're then not depleting the money that you've got, you're probably also growing it. So that's why it can be sometimes an inelegant solution, because what you own when you're 60 isn't what you own when you're 70 or 80 or 90. So you might take a life insurance, you might have an inheritance tax bill today of 200 grand. So that'd be $500,000 above the limits. By the time you're 90, that might be 400,000.
Okay.
So at that point, you've sort of done a bit of the work, but your problem's got bigger. Yeah. And if you've got £1 million house, the chances are that in 30 or 40 years, it might have even doubled in value.
Okay.
Right. So it's a moving target you're trying to hit all the time. So it's not the most elegant solution, but it is a solution. The third thing that you can do is that you can give money away, and you can give money away either directly, here you go, son, daughter, grandchildren, here's a bunch of money. Yeah. Everybody has an annual exemption of £3,000. You can carry forward the previous years if you haven't used it. But in the estates that we tend to deal with, that's quite small potatoes. Okay. So, but it's useful, and you should utilize it. You can also gift away any amount out of regular income, provided it doesn't impact your standard of living.
Okay.
Right. And it's excess income.
Yes. So
if you had, for example, you had a state pension and a final salary pension, then they go up every year, but your expenses don't go up every year, and you find that you're actually banking £20,000 a year, you could give that £20,000 away without it attracting inheritance tax, without it being considered to be a potentially exempt transfer or a chargeable lifetime transfer, which are the two sides of the same coin, essentially. But you do need to be careful with logging it, and make sure that it's a regular gift and that it's evidenceable, and also show that it hasn't changed your standard of living.
Yes. Yeah.
Yeah. And then beyond that, and this is the bit where again, these things might stop your problem getting worse, but they're not going to eradicate the problem. You can make significant gifts, which again might be a potentially exempt transfer or a chargeable lifetime transfer, depending on how you give them. And you can either give that away directly and say goodbye to the money, or you can put that into some kind of trust, which will allow you to have some sort of reversion or income from that to get that money, get part of that money back if you need it. Yeah. And that's when you start getting into a bit of a deeper conversation that you might need, a flip chart or a board or something to break it down for clients. And of course, what happens is that you start saying about this, and then you get a question about that, and you end up, you're answering a very broad range of questions because different bits of this equation matter to different people. And then finally, your fourth solution is to buy an asset that doesn't attract inheritance tax, something that benefits from what's called business property or business relief.
Yeah.
And although you still own the asset, the asset is 0 rated for inheritance tax.
And is that only for business owners, or can your average?
No, your man on the street who's got a job, working in the civil service or as a fireman, or a doctor, they can do that by utilising the expertise of other companies who have constructed portfolios of smaller companies that do attract the relief. If you happen to own a business, so my business, for example, if it's worth less than £1 million, I can leave that to anybody, provided I've held the shares in the company for more than 2 years and they still belong to me on the day of death. I can claim relief on that. Above £1 million, the relief changes and you end up paying, at the moment, it's 50% of the amount that you would pay on that. Yeah. So that'll be 20% rather than 40%.
And in your experience, so from listening to all of that, there could be people watching or listening that are like, blimey, that all seems very complicated. And sometimes, although you're not selling anything, you make recommendations to people. And sometimes people shy away from things that they can't quite get their head around. So I guess two parts of the question: how do you communicate complex things in an easy to understand way? And two, is there a simple approach to reducing inheritance tax that most people will go for because they understand it?
I think the important thing to remember, John, is that, as a boy from East London, it might seem unusual for me to be quoting Einstein, but Einstein made the point that the level of thinking that got you into a situation won't get you out of it.
Okay.
Yeah. And so you've spent, if you're now 75 and you've been at work since you were 20, you've spent the vast majority of your life accruing money and living in a certain way. Yeah. And if you continue to do that, your inheritance tax situation isn't going to get any better. So you've got to utilize one of those 4 strategies, or probably a combination, and most people use a combination, to be able to come out the other side and say, look, here's a plan and this is how we're going to reduce it. And so I think what happens with most people is they come along and they hope that we've got a magic wand and say, oh, do this magic thing. And there are people on various social media platforms who have got, buy a trust and it'll solve all your problems. And certain trusts can solve certain problems, and we use them, and they do. But there isn't one that is just a magic bullet.
Yeah, it's not a product that you sell, if you know what I mean.
No. And anybody who says
it's not a tea cozy.
No. It's not the panacea and the solution to all problems. And generally, what happens is that you can solve one problem, but you might create another one. So, for example, you can gift money into trust, which is great, but you can't have it back. Yeah. You might be able to have a distribution from it, and also you've got to wait 7 years potentially before that money's outside your estate.
Yes. Yeah.
Yeah. So they're the negatives, but if you carry on doing what you're doing, you'll keep getting what you're getting.
Yeah.
Yeah. And the situation won't get any better. Most people do have concerns about putting large amounts of money into the names of their children or into their children's hands, because they've, you're still a parent, and no matter how much you trust your children and no matter how sensible they are, you still worry.
Yes.
And what we try and do is we try and manage that and work with people so they understand what they can gift away, but still have perhaps a little bit of control over.
Yeah. Yeah.
And that often eases people's concerns.
That's good. That's good. Thank you. Enjoyed that.